welcome to the Sharon Partners quarterly market update for the June quarter 2022. I'm Kim, an advisor with Sharon Partners, and as always, I'm joined by Steve. Steve, thanks for joining us this morning. It's been quite a tumultuous period in the investment markets. What can you tell us about what's going on in the Australian market?
Yeah, Kim. Well, in the first quarter, the Australian market sort of defied gravity. It had a small positive return when every other market around the world was negative. Well, we've now caught up with the rest of the world, so we've had quite a tough quarter, as I'm sure everyone knows. The Australian market's down 11.9% for the quarter.
And what can you tell us about the international markets then over the same period?
Yeah, so quickly just moving to the rest of the world, if you like, the developed markets, they're down by 8.4%. And the emerging markets, they're down not as much by 3.3%, but don't get too carried away by that because the emerging markets are down by 18% over the whole year. So they've really been hurt by inflation, the Russian invasion of Ukraine.
And Steve, we've been hearing lots of noise about the big tech stocks.
Yeah, sure, Kim, that has been in the media. Here's a chart showing the US market and the high-tech stocks, which are represented by the FANGs, the Facebook, Apple, Netflix and Google. Now, over the whole half year, the US market's been down by 20%, and that's what they call a bear market, which you may have heard of. But the high-tech stocks, they've been down by more than 30% throughout the half year, and even in this quarter you can see they're down by 25%. So they've been hit the hardest, but of course keep in mind, prior to this, over the last 12 years, they had been the best returning part of the markets as well.
They've been hit hard in this period, Steve, but last time we caught up, we spent the whole time talking about bonds.
Yes, we did. So bonds were sort of first cab off the rank. Bonds bore all the pain, if you like, in the first quarter. And I think the equity market looked around going, I wonder what's going on with those guys. Anyway, the equity market have now firmly in the headlights in this second quarter. Bonds are still negative, Kim, but obviously not as much as the first quarter. And the other thing in the chart we're showing, Kim, we've got the quarter by quarter returns to the bond market, but we're showing the yield in the top line there. Now, yields and bond prices are inversely related, so if the yields have gone up, bonds have gone down. But you can see that in the last couple of weeks, those yields are starting to come down again, and so many commentators are saying, look, the bonds have certainly worn the pain, but they're now sitting there unlikely to go down any further. And in fact, if anything, they're starting to go up a little bit as they provide protection as the equity market is going down.
Steve, it has been a really volatile period in the markets, and the media certainly has some doom and gloom reports with that word recession being thrown around.
Yeah, absolutely, Kim. Well, for clients, try not to listen to the media because they love doom and gloom.
And of course, Sharon Partners, our philosophy is to just maintain a really well-diversified portfolio so that it sort of doesn't really matter what happens in the markets. We know we're going to come through that okay.
Yeah, that's right, Kim. Keep in mind that these sort of market downturns, they're not uncommon. It's a little bit unsettling, and I think everyone's got used to the market going up and up, but this is not unusual to have these sort of market downturns. It's not unusual to have recessions. But in the long run, Kim, and in the chart we're putting up now, you can see that over the long run, the market does go up.
I think that's really the key, that it's not uncommon and it's not unusual. This is just part of the cycle.
It's a part and parcel of investing is to have a little bit of volatility. It's certainly unnerving when you're there, Kim, and we absolutely understand that. But, Kim, there's some data that says that, in market downturns, it typically takes a year for the market to fully recover. And certainly after 3 years, in nearly all circumstances, the markets have fully recovered in a way ahead of where they were. So market downturns are not uncommon and they tend not to last very long.
That's certainly less doom and gloom than I think we're seeing all over the headlines. Thank you, Steve, for that information. It definitely helps to have a bit more of an understanding. And thank you for joining us. We look forward to seeing you at the next investment update.